Good morning. Welcome to this first SmartWealth.ai webinar of 2026. We appreciate you taking time to join us on this Sunday morning. My name is Sumit Singh and I'm a partner at SmartWealth.ai. Along with me, we also have Pankaj in this webinar. Pankaj is the founder and principal researcher of SmartWealth.ai. So before we start, let me quickly talk about the structure of this webinar. So we are going to start with a short presentation by Pankaj. The presentation is going to cover some important topics like the macroeconomic and bullion situation right now. We are going to review the markets and our products. We'll have a short overview of SmartWealth.ai thesis and some details about our flagship DSP portfolio. Along with that, we are also going to talk about how you can make best use of SmartWealth.ai. So that includes some frequently asked questions and also some support resources that you can use, which will help you in your investment journey. And this is going to be followed by a Q&A session. We know it's an important day. Budget is going to be presented shortly, so we'll try to wrap this up in around 45 to 50 minutes. And while Pankaj is presenting, if you have any questions about the content being shared or any other topic, please feel free to type it in the live chat and we'll take it up at the end of this session. So with that, I'll hand over to Pankaj. Pankaj, over to you.
Hi, everyone. Thanks, Sumit. So, thank you very much for taking time to join this webinar on Sunday. Also, it's not just any Sunday, it's a budget day. So, I know you have, you'll be looking forward to budget session as well. So, we'll try to wrap up definitely before 11. Hopefully, we can give you 10-15 minutes before so that it's not tight for you. So I'm just going to start sharing my screen. Sumit, if you can confirm when you see that.
We can say it now, Pankaj.
Okay, excellent. So let me get started. Please read the disclaimer. And if there are any open questions at the end of the presentation, please feel free to email those to us at connect@smartwealth.ai. Like Sumit said, we'll try to take as many questions as we can in this session itself. On the bottom right, there is a QR code. If you wish to follow us on LinkedIn, where we do give market updates from time to time, you can scan that and connect with us on LinkedIn. So the first topic, the macroeconomic review. In this topic, we have two parts. One is looking at the global Indian macro picture, as well as some geopolitical connections to the macro picture. And the second part is looking at the bullion situation, which is gold, silver, what's happening, what has been happening, and therefore, what are the implications for us. So first thing, the macro situation in India, the recent January review by RBI led to a decision of maintaining the interest rate status quo. So this has come in the backdrop of 3 rate cuts in 2025. So 2025 inflation was in control, and there was an opportunity to reduce rates, thereby facilitating credit availability in the economy and accelerating growth. And the growth trajectory that we are on and the forecast for that trajectory is all great. So 6.5 plus. So it's a great backdrop for the investment sort of decision making, and also it's a good position to be in. The last rate cut was in December, so it takes about 2 to 3 months for banks to become profitable or adapt to that new interest rate. So we still have a couple of months for banks to be able to process it completely and sort of adapt their earnings to the new interest rate regime. So as of now, the earnings season of the last quarter ending December, there's nothing remarkable coming out of it. No real strong momentum, neither across capitalization levels, nor sectors, nor themes, etc. So there is general sort of sluggishness, and while large caps are showing slight uptick, but it's not strong enough for us to say that the growth has started. Um, Also, if you see, one of the biggest news these days is the FTA that India has signed with European Union, and this comes in an environment with massive, tariff conversations and geopolitics around tariff and economy. So this is a great positive. In the last quarter of 2025, India had also signed with UK and a few other places. So if you see the collective GDP of the countries or economic blocks that are covered in these FTAs with India, more than 25% of the world GDP is represented here. So really, if this clicks and has a positive rub-off on economy, it should significantly boost medium-term exports, and also in long term, it also has the potential to unlock the manufacturing themes for India. So overall, India has a very good picture. The picture in the US is not as pretty, and what happens in US does not affect only US, it affects the whole world. And the situation in US is that of a fiscal deficit. So they have a national debt of 38 trillion, which is much larger than their 30 trillion GDP. And just to kind of help us appreciate how big that debt is, the interest rate payment on that debt alone is larger than their defense budget. So it's really showing, the debt as the central theme, or mitigation of debt as the central theme in their overall national macro thinking, economic thinking, geopolitical thinking. So that's the context. And last year, they had undertaken two rate cuts, and this occurred in an environment with high inflation. So costs were already escalating, and when you reduce interest rate in such a regime, it has impact on further increasing inflation. So it's really telling us that they are pursuing inflationary, reflationary monetary policy, so which is basically pursuing nominal GDP growth when real GDP growth may not be that great. So pursuing nominal even at the expense of inflation, and that's actually the posture they have taken. A few things stand out in their macro picture. One is, the government is trying to raise its revenue via tariff. So they have a very tariff-led approach to increasing government revenue, and therefore sort of mitigating the fiscal deficit. And a lot of global supply chains are getting restructured by this tariff restructuring. Also, there is a movement from outsourcing-led growth model to somewhat towards insourcing, not led, but somewhat greater insourced, sectors, and it's yet to see in which all sectors they will be able to insource. One of the things that stood out last year in US is the US dollar depreciated between 8 to 10%. Now, when US dollar, which is the Federal Reserve currency, the global reserve currency, when that depreciates, all the US denominated assets appear to be appreciating because it takes more dollars to afford those assets. So a lot of growth in apparent growth that we are seeing in US dollar denominated assets is actually a reflection of US dollar depreciation, and which is not a very good picture. And the think tanks, macroeconomic think tanks, they've been saying that dollar must depreciate by 30% for it to come on par with the value it provides, or a parity that the world is looking for. So as far as big picture is concerned, some dollar depreciation has occurred, but not enough for the world to kind of stabilize. And in this context, if you see the January Fed meeting recommended not to reduce interest rate. And soon after that, the federal governor was replaced. And the new governor has an image to be hawkish. In other words, to reduce to curtail interest rate reductions and thereby arrest the dollar fall. And as an immediate reaction to that, there was 8 to 10% correction in gold prices. Now, whether this posture is going to remain as the policy stance, this hawkish stance, is yet to be seen. And whether this gold correction that we saw in the last week of January, whether that is a reflection of monetary policy or it's a profit booking is again yet to be seen. I think the February review will clarify a lot of things on which direction US is taking, and as an extension what's going to happen in global macro situation and Bullion situation. On the right side, the globe, couple of things that stand out from global news and developments. Geopolitics, we all have been getting feelers, but starting with economic one. So Japan has had unprecedented inflation for a country that's not growing, high, at a high GDP growth. And as a result, last year they had undertaken increase in interest rates. So far they have been a zero interest rate economy, and they raised interest rates. The interest rate in Japan is around 30-year high as of now. So it is disrupting or is going to change the flow of capital in the global scene. So because Japan had zero interest rate, it was a popular source of capital for the world. Also, large amount of capital in tens of trillions of dollars was flowing from Japan to US. And because Japan had zero interest rate, US had much higher, so it was almost like a carry trade. You source capital low, generate return and profit from it. And now with Japan interest rate going high, that kind of trade is no longer viable. So we will see liquidity drying out in US. One of the factors for liquidity drying out in US will be this. Um, in geopolitics, large part of geopolitics is essentially a manifestation of the gross national debt of US, also the US dollar depreciation, and weaponization of reserves. So, US and its allies had frozen the US Treasury that were held by Russia, and that kind of sent shockwaves across central banks. That US dollar, while it is a Federal Reserve currency, it is not a neutral asset. So if you as a country are keeping your national reserve in US dollar, you may not necessarily get it back when you need it. So that has changed, the strategy across all major federal banks, central banks. And also among trading partners, mechanisms are being devised to be able to trade without using US dollars. So one such example is BRICS, which is devising their alternate settlement mechanism that uses the currencies of the participating nations, an average of those, and blended with gold. So it's kind of moving to neutral currencies and neutral assets. And how much adoption happens is yet to be seen. But clearly, people are thinking and mitigating the geopolitical risk arising out of monetary policy situation and fiscal situation of US. Also, increasingly, you would see oil-related geopolitics. So Ukraine was much known. Ukraine, Russia is one of the oil sources. Also, nuclear power, etc. But oil source. We recently saw Venezuela, US intervention in Venezuela, and Venezuela is the largest oil reserve in the world, which is $19 trillion. Iran, US intervention in Iran is also surfacing in the last couple of weeks. Iran is the third largest oil reserve, which has about 12 to 13. If you look at the movement, while they may appear purely random, but there is a clear economic rationale, not necessarily justifiable, but a rationale on why these things are getting connected with the economic situation. And in all of this, the policy uncertainty, the policy volatility, as well as geopolitical volatility is driving and has been driving flight to safety, which is, causing gold to be rising steadily, rapidly over the last 1.5 years. So with that, let's review what's going on in the Bullion world. So Bullion World gold, silver, they've had massive rally in the last, 1.5 years. But actually, if you see, they've been rallying since COVID 2020. And this kind of movement, so here in the center of the page, if you see the bottom, number three, that's the picture of the current world. So 2020 onwards, it has been rising. And in the last 1.5 years, the rise has even, accelerated. Now, this magnitude of movement has not happened too many times in the past. In the last 50, 60 years, it has happened only twice. So the first time was when Nixon broke this gold dollar linkage, this fiat breakdown, and caused, loss of gradual erosion of confidence in the fiat currencies, not just US dollar, but fiat currencies all across the world. And that led to money movement into bullion gradually over 5, 7 years. And once the confidence was restored in the global monetary order, the bullion stagnated and they started correcting. Again, this correction took many years, but they corrected. And similar situation happened around subprime crisis. So the main visible event of subprime crisis was, two, three major events were around 2008, but the conditions were building a few years earlier. So they started building a few years earlier. 2005 onwards, you would see bullion was gradually rising, gold, silver, both. Um, and they reached a saturation point around 2011-12. So this represented period of eroding confidence in the global monetary system, global financial system, but it reached some sort of equilibrium in 2011-12, and thereafter the confidence in financial system was improving, and then gradually bullions corrected. Now, why we look at this? So we look at it for one reason, that we've seen the rising side of gold in the present episode. What's going to happen next? That's a question in everybody's mind. We also are not any expert with the crystal ball. Also, we hate to make any forecasts, but some of it can help us understand what might happen and what might be the scenarios. So what have we learned from these first two episodes? So first episode has, these episodes have taught us a couple of things. One is the erosion of confidence in monetary system until it reaches some sort of equilibrium. This process is 5 to 10 years longer. The second is, in this process, a stage comes when silver rises more than gold. And that's telling us, we are approaching saturation. How long it will take, we don't know, but it is moving towards saturation. The third thing we observe is, once the correction phase starts and correction occurs, silver loses most of the value, whereas gold retains greater value than silver. So these are the two, three things we've observed and learned from the past, and we will try to connect the dots in the next slide. But let's delve a little bit deeper into the present situation. So there are a couple of aspects. So one is, in this bullion, of course, while this is lasting, this is a good opportunity to not only grow standalone trades, but it's also a good hedge against equity sort of movement. And gold and equities have traditionally been negatively correlated to each other. So it's a natural hedge against equity volatility. But what we are seeing is ETF tracking error. So people participate in gold market via ETFs, and one would expect ETF and asset to have identical movement, but there is persisting tracking error. So it is not exactly mirroring the asset movement. That's an issue. Also, slight movement in the asset gets amplified by ETF movement. So really, those are the challenges to be aware of, and we'll talk in the next slide on what implications it has. Now, more importantly, what is the way forward? So we know that this rally will not last forever. So at some stage it will stagnate and correction will start. But when that is, we don't know. The scenarios are as follows. So one is, a lot of it depends on the Fed decisions in the US. And if the Fed continues a policy of, depreciating dollar to come on par with, a fair, equitable valuation for the world. If that happens, gold will continue on the bullion cycle. And by January, it is possible that gold would have risen 40% from the present level. That's one scenario, one end of the spectrum. The other end of the spectrum is that indeed, the Fed takes credible action to arrest the dollar decline, takes credible action to stop excess liquidity. And if that happens, the equity valuations would go up, and the gold might see more than 20% correction, up to 20% correction, let's say, by December. But the path, we don't know, and also it will be, full of volatility. So something for us to be aware of. If it was clear one way or the other, decision making is straight. But yes, so that's the world we are in. So what are the implications? So before we go into broad implications of Bullion, let's just specifically spend a minute on tracking error. So if you see on the left chart, the black line is the asset movement, which is gold movement. And the lines below that, they are the ETFs that are trying to replicate gold. So there are five most popular ETFs in India, and all of them have this tracking error. So what is happening is these ETFs have to actually procure gold. And given the amount of money that is flowing in, which is causing a liquidity squeeze, it is making it difficult to mirror. While we would want it to be, and they would want it to be, this tracking error is very significant compared to the asset price. So there's something to be aware of. Also, if you look at the 22nd of January mark, small price movement in the asset got amplified as a very multifold price movement in the ETF. So it's not accurately reflecting, and this we should be aware of. And what it also means, as an investor, we should gradually deploy capital. Don't take large concentrated position in any single day, or in a very small short period of time. So spread your bets over a period of time to average out volatility, and that's one way to manage this, because what happens to ETF is not in our control, but how you adapt to it is in your control. So that's something to be aware of. And of course, the equity market and gold market has risks. So please be aware of volatility in the portfolio to determine how much allocation you want to make. Broader implication on the right side, like we observed in the last slide, silver is more volatile than gold, also loses most of its value after correction. So it is not a suitable asset for hedging. Gold is a much better asset for hedging, and our framework takes care of this. We do not use silver ETF as a hedge. We only use gold, so that we should be aware of. The second is, while this is a nice long rally, it will not last forever. So it needs a dynamic approach. So not a fixed gold approach. That's our philosophy. Also, this cannot be a response to an event. This has to be a programmatic way of, rules-based, schedule-based approach of adjusting or adapting to the situation. So it won't be like we see the news and we do something immediately. So there is a schedule through which decisions are made. All the stocks decisions are made once a week. All hedging decisions are made once or twice a month. So all gold allocation related decisions will be made through the same cycle. The other thing is these decisions are not made by me. These decisions are made through a very set rules-based system, and it uses mean variance optimization as a method of deciding gold allocation. What mean variance method basically means is this system will consider various scenarios of, less infusion to more infusion of gold, and test all of those scenarios on historical recent history, and choose a level of allocation that will maximize the combination of mean to variance. So in other words, we want greater mean returns, but we want smaller variance of returns. So in other words, we want higher risk adjusted returns. The combination that maximizes that will be chosen by the system. It's not a human decision. We don't want to make such any decisions by ourselves. Also, we will not respond to qualitative information, news and events. It is done in a scheduled, rule-based manner using the well-known framework for making such decisions. So that's wraps up the Bullion review, and moving on to product and market review. Before I move into reviewing our products and markets. First of all, a huge thank you for your trust and confidence in our diversified stocks portfolio. Our Aspire diversified stocks portfolio is currently among the most invested small cases, and it is also among the most subscribed small cases. So thank you for making DSP a huge success. Aspire DSP and Sprint DSP, they're both from the same families, family of small cases. They both completed 4 years last December, and they are now showing up in 3-year returns. And among the momentum small cases, these two small cases are among the top by 3-year ranking. So this is a sort of testimony to how a diversified approach across asset classes, across sort of capitalization level themes, and with diversification and hedging kind of endures conditions across broad set of market regimes. So the first product and that we are going to review, or actually it's not exactly product by product, but the first review is review of asset classes and our diversified stocks portfolio. On the left side, we see 1-year trend of asset classes. So there are 3 major asset classes we've seen here: debt, then equity, and then gold. So as we are aware, last 1 year, debt has been almost flat, slightly negative. Nifty shows about 7-8% growth in the last 1 year, but if you consider a slightly longer period of 5 quarters, it is flat. We are still sort of at similar level that we were in September 2024. And by comparison, gold has considerably outperformed, and gold has delivered 90+% return the last 1 year. On the right side, if you see equity index versus our Aspire diversified stocks portfolio. You see the market has been somewhat flat for the last 5 quarters, but during the same time, Aspire diversified stocks portfolio has done slightly better. And this is because of dynamic gold hedging. So the algorithm has 4 layers of decision making, which we will see in the coming slides. And the last layer of this is dynamic gold hedging, and which is also done by system-driven, rule-driven manner. And that has kind of helped mitigate the volatility in the equity side, and not only mitigate volatility, but also drive substantial upside. And similar is the situation with Sprint diversified stocks portfolio. They both use this same diversified stocks portfolio framework with minor differences in the use case. So Aspire stocks portfolio is a portfolio of 5 stocks designed to manage a maximum of 10 lakh. This supposed to be some sort of a starter plan for those who want to experience our framework. The Sprint diversified stocks portfolio is a portfolio of 30 stocks. It's a much more broader and great, portfolio with greater diversification. It is designed to manage up to a maximum of 25 lakhs. And both of them have done well, largely because of dynamic gold hedging. Now let's review the factors. On the left side, we have the graph of 2 major factors compared with Nifty. So black line is Nifty, and we have alpha and low vol. These are the 2 major factors that drive growth and sort of in a diversified way. And these 2 we consider in our portfolio formation. The first observation is both the factors are below Nifty. So factors have not yet started firing. That's the first thing we observe. The second thing we observe is, alpha is below the 0 line and low vol is above the 0 line. So it's not the time where alpha as a factor has started firing, and alpha is a factor that fires well in a bull regime. So it's a reconfirmation that we are not in a bull regime yet, not in a strong bull regime yet. Low vol is doing slightly better than 0, but worse than Nifty. So it kind of says that yes, low vol is not destroying value. A low volatility based index, this index does well in risk off period when people are trying to mitigate risk in their portfolio. That is when these kind of stocks do well, this kind of index does well. But it is not doing as well as a diversified approach. So it's still below. So that's the quick, big picture of factors. On the right side, you see how factors portfolio has done in the past, and how does that compare with what's going on in the equity world. When we reviewed this in November webinar, this had exposure across low wall factor and gold. Gradually, algorithm has decided in favor of gold. So it exited low wall and it has entered most of the allocation in gold. And this is a reflection of what's going on and where is the momentum in the outside universe. Overall, this approach of managing portfolio based on factors, it it tries to achieve risk adjusted return in a somewhat different manner than our stocks portfolio. So the results of this tend to be less correlated with our stock portfolio based approach. So over a long period of time, there's a good diversifier. So for those who are using our stocks portfolio, might consider this a good a mechanism to add some diversification in their portfolio. The last part is themes. So on the left side, we see two pictures. So first is review of themes at the time of launch of this portfolio, which is July of last year. And the second picture is from the launch till today, what's happened in factors. So what has happened in themes. So if you see the first picture on the left, most of the themes, there are enough number of themes doing better than zero. So there was strong thematic momentum in July. And we formed a portfolio consisting of defense, capital markets, and oil and gas in July. Now, if you see the second picture, most of the themes are below zero line. So really thematic investing as of now is not firing, and most themes are underwater. Slight positive we see in banks, which is the only actually theme above zero line. And this is in anticipation of banks becoming profitable. But last the December rate cut has actually kind of put pressure on banks' profitability. So it will be interesting to see whether this continues. But overall, the picture is that thematic investing is not firing at its best as of now, or also not just now, this last few quarters. On right side, you see how our thematic has done, how it has adapted. So when we launched, one black swan event hit us, and like everybody else, we were holding IEX, which is a capital markets company, and this stock crashed almost overnight by 30%. And this was because of some regulatory changes that impacted the business model of IEX. And from that point onward, gradually, portfolio has been gaining relative advantage. And I would say more or less it is in line. But uh, considering that this is a stress time for thematic, this has maintained the portfolio volatility quite well and arrested possible decline, which we see on the left side. For it to fire, I think broader positive momentum in themes have to be seen for such a portfolio to fire, which we are not seeing as of now. But when overall market improves, themes improve, then this portfolio should do better. With that, I'm on the third section, Smart Wealth thesis and our diversified stocks portfolio framework. We have received a lot of questions and queries from investors over the last couple of months. So we thought it is a good idea to sort of spend a couple of minutes to walk everybody through how this works. The first part of this is looking at the broader philosophy of and thesis of SmartWealth.ai, which is what we call diversified momentum investing framework or philosophy. The second part is specifically looking at diversified stocks portfolio, the rules of this portfolio, different decision-making layers of this portfolio, and how it achieves, growth, risk management, diversification, hedging, those kind of things. The first part about the broad thesis, we've discussed this in the last webinar also, in the November webinar. So we will not go into a lot of detail. And if you would like more detail, you can refer to the our YouTube video from the last webinar. But as a context, if you look at long enough periods, so on the first chart on the left is a 200 view of asset classes from US, and it shows that across very long period of times, stock does better than any other asset class. So clearly, if growth is the objective, stocks is the place to be. Now, what is the challenge? If you see the second picture, equity and stocks, they are full of drawdowns. So there are many deep long drawdowns one will have to face. So essentially growth is there, and if you can manage the drawdowns, growth will automatically compound a little bit better than average. Even to start with, it has great growth rate. So the crux of diversified momentum investing is to mitigate these drawdowns as much as possible. And if we mitigate the drawdown, automatically, a manageable way of investment will be available to most people, because for most people, these kind of drawdowns are a barrier. So that's our focus, to mitigate, deep long drawdowns as much as we can, and thereby, provide a way of participating in equity to most people. But here's the caveat. Buying and holding stocks is not the most effective way of participating in stocks. And why is that? Because stocks do not have persistent momentum for too long. So they have bursts of growth and long period of non-performance. And if you see even the best 50 companies that were a part of Nifty when Nifty was started, among that cohort also, two-thirds of those are not in Nifty anymore. That means they lost relevance, lost momentum. A lot of things happened which made them discontinuous. So it is not a great idea to just buy and hold stocks. Not the most effective way to beat the market. And if that is your objective, then buy and hold will not get you there. So what may be some of the options? That's on the right side. Prices are not purely random. Prices have positive serial autocorrelation, or prices have momentum. So a good momentum algorithm would be able to detect that yes, some momentum is being seen. So when some momentum is seen, then you would participate and you would hope it to continue. So two things can happen. It can continue, or it may be a false alarm, or it may lose momentum. If it continues, you stay invested. If it doesn't, then you exit. And this approach is not an approach with very high win rate. In fact, most of your trades will be loss making. So less than 50% of the trades are profit making, but the odds over a long period of time are in your favor. So this approach does not wait to buy low. It buys when some of the upside has already happened, and then participates, and it doesn't hold forever. It periodically reviews. And a lot of research across the world shows the frequency of this review is one of the major driver of performance. So your ability to adapt to changing momentum, changing pattern, changing trend, that is what drives performance. And the second driver of performance is concentration. How concentrated your portfolio is. Is it a 50 stocks portfolio, 20 stocks portfolio, or 5 stocks portfolio? That drives. So by managing concentration and frequency, the portfolio tends to amplify the trends in the market, which is great when the market is rising. It's not great when the market is falling. So something else is needed to manage the risk, because this will tend to amplify risk in the portfolio. And the way to manage risk is by blending uncorrelated assets with the portfolio. So uncorrelated, negatively correlated assets, when you do both, that is how a diversified momentum investing framework is formed. And in our portfolio, we have 5 levels of diversification. If you consider our overall DMI portfolio, considering of all the baskets. So we diversify across sectors, across market caps, across themes, across asset classes, and across strategies. So that means it's also possible for us to have portfolios that will sort of combine different strategies, etc., to be able to mitigate risk. So really, our undivided focus is on diversification. Actually, even the name of our philosophy is diversified momentum investing. So diversification comes even before we think of momentum. And there are 3 ways we capture momentum. Those are 3 strategic portfolios or pillars. So momentum in stocks, momentum in assets, momentum in factors. So we have portfolios among each of these. Also, we have portfolios that combine these. So we have two-in-one portfolios, two-in-one portfolio and three-in-one portfolio. So those are the way we manage risk. And these are packaged for four different personas: Aspire, Sprint, Endurance, Triumph. Aspire is for managing maximum of 10 lakh investment. This is for the people who are still, in the early part of their journey. Sprint can manage up to 25 lakhs. Endurance 50 lakhs, Triumph 75 lakhs. So this is our overall framework, specifically about how diversified stocks portfolio works, because this is our flagship portfolio, and most of the subscribers are on this portfolio. And considering the number of questions we have been receiving, the amount of interest people have about how decision making happens, how would this adapt to gold? Now, how will it adapt to change in momentum of gold? When will it come back to stocks? I think once we understand how this works, it will answer most of the questions that you might have now or in future. So the objective of this is to outperform the market as much as possible by taking intelligent risk and mitigating massive crashes like subprime crisis related crash or COVID type of crash. So in when major crashes are manifesting, then this should be able to mitigate some amount of risk as much as possible. Let's say at least half of the risk. That's our goal, not an assurance. And if we are able to manage that, growth is automatically there, because there is growth in equity more than others. So, and we implement this using four layers of decision making, what we call plan A, B, C, D. So the base plan is to have a core momentum portfolio of a predefined number of stocks. So the predefined number of stocks for Sprint is 30, and predefined for Aspire is 5. So the goal is to form that core portfolio of 5 or 30 stocks. And it starts with a universe which is diversified. It doesn't have any sector, market cap, or theme concentration in the beginning. So it is a diversified universe to start with. Then it must pass three checks or three filters for us to consider. So first is regime filter. These stocks must be rising for us to consider. The second is they should have adequate liquidity. So they must have certain minimum average daily trading value for us to consider them. We don't want to get in or out of stocks that don't trade enough. And the third is they should have acceptable volatility. So the stock should not be undergoing wild swing for us to consider. So once stocks pass these three, we have set of stocks that are rising, that are liquid, so you can enter, exit them easily, and they're not volatile, so portfolio should not have wild swings. And the stocks that qualify among this, we sort them by momentum and consider the stocks with the best momentum. And so best 5 for Aspire, best 30 for Sprint. And our base philosophy is equal allocation. So when on the first day, when we form, they will all have equal allocation. So 20% each for Aspire, 3.33 for Sprint. As time progresses, of course, when the prices change, the allocation would automatically drift. We tolerate some amount of drift. We review this once a week, typically on Wednesdays. So it comes to you on Thursdays. What happens when we don't find enough number of stocks that meet these criteria, right? We have strict liquidity, volatility, regime criteria. So when we do not find 30 stocks, some of those 30 slots will be empty in Sprint. Some of those 5 will maybe empty in Aspire. So that is when plan B is activated. We consider sector ETFs. Sector ETFs are a way to continue to participate in equity when direct stocks are not performing. So that's a plan B. And if sector ETFs are performing, some allocation can go to sector ETFs. Then plan C is if there's still some gap to be filled, then debt ETF will be considered. So automatically, if you see, plan A is direct stock, plan B is sector ETF, which is equity, plan C is debt. Now, a combined portfolio of A plus B plus C, this is measured against gold, and then various scenario of gold diffusion are tested. So for each of these scenario, the mean variance optimization algorithm is used. So it dynamically checks various scenarios of gold hedging and the level of gold that will optimize the mean variance of the portfolio that is taken. In the end, this approach dynamically adapts to gain of momentum in stocks, loss of momentum in stocks, whether to go to debt or whether to go to gold. All of this is done in a rule based manner without human discretion. And we'll see a little bit visual depiction of this in the next slide. And like I said, most of the decisions are made on a weekly basis. The large decisions of hedging diversification, they are made on a monthly cycle. So for you to deploy your SIPs, the first week of the month or the first Thursday of the month is ideal, because by that time all major decisions would have been made. And this is available in two different capital sizes. Aspire, which is a portfolio of 5 stocks, and it can designed to manage up to a maximum of 10 lakhs. Sprint, which is a portfolio of 30 stocks, is designed to manage a maximum of 25 lakhs. So that, and how might it respond or adapt to regime? Visual depiction. So when we are in strong bull market, you might see most of the allocation is going to gold. When you are in strong bear sentiment market, you might see most of the allocation is made to gold, and in between. So from stocks to sector ETFs to debt to gold, it automatically adapts and gradually adapts to what's happening in the market, and that is what makes it effective in mitigating risk. That is also what adds to its advantage, delivery of upside over a period of time. So with that, we have an announcement to make. We actually announced, price revision last month. I think actually in December of last year, we announced a price revision of Aspire. So we've not increased or revised prices in Aspire for a very, very long time, and this is an attempt to come on par with the market prices. And Aspire prices, revised prices, will be effective tomorrow. Sprint diversified stocks portfolio price revision we are announcing today. It will be effective 2 quarters later. So there is a 2 quarter period for you to enjoy Sprint at a price lower than that of Aspire. So this is an opportunity to consider Sprint. Also, there is a 15% discount, a limited time discount that is going on in Sprint. So I encourage you to watch list this, and I hope you make use of this 6 months period to evaluate Sprint. So with that, moving on to the next section, how to make the most of SmartWealth.ai. This is essentially about the resources that we've built to help you manage your journey in a most effective way. And this has got learnings that we've accumulated over 4 years period of being on small case. So most of these resources are on websites, some are on other platforms as well. We will share those. To start with, now let's go through the website, home page, product page, and a few others. So I'm just going to move to the website. So our website, it's already open, but I'm going to type it anyway. So it's SmartWealth.ai. So when you type that, it'll take you to the website. On the home page, you would see content organized by personas that we serve: Aspire, Sprint, Endurance, Triumph. If you go a little bit down, you will also see content organized by the family of strategies we have. So stocks based, assets based, factors based, and combination. So you could, from anywhere, you can go to products listing page, and on products listing page, you can view them by personas or view them by strategies. And for any portfolio of ours, you can actually click on this and go to the page where it'll provide details on how exactly this portfolio functions. There's a text description that kind of describes how how the framework works and how the the rules of momentum, rules of risk management works. There's also a video. This video has, conversation in two parts. First part talks about our overarching diversified momentum investing framework. The second part has specific rules about, the portfolio that we are talking about, any given portfolio. So most of the questions that you may have about strategies are already answered here. If there's any unanswered thing that we can, you can reach out to us and we'll be happy to answer. The other resources, testimonials. So many of our successful customers, successful investors, subscribers, they've been very kind to share about their journey. So what were they going through in their investing journey, and at what point they use our products, and how they use our products. What are the lessons that they have learned? They very generously shared those lessons. Please feel free to go through them. I'm very confident you will find this useful. The other resource is blog. So from time to time, we write market insights and we post it here. So you may want to, visit this from time to time and get an understanding of how we are thinking about various things in the market, in the economy, global, India, and so on. Also, we write some, content related to quant investing. In fact, we are going to ramp that up. We'll see that in the coming, slides. So brings us to the most important part, most important resource, which is FAQs. This is very thoughtfully curated. It has questions that get asked very often, and our 4 years of troubleshooting help has been synthesized here. It is organized along four categories. The first category is about strategies. So how do you select strategies? Why strategies have certain rules? How to select, how to sort of expand capital, how to diversify. So, conversations related to strategies are organized here. The second topic is investment deployment. Our thoughts on, SIPs, lump sum amount, any event-based allocation. Our thoughts and what we get asked most often is here. The third part is about execution, rebalancing, when to rebalance. This is happening in rebalance, what to do, why rebalance works in a certain way, certain observations that you may have. You may find most of the answers here related to rebalancing and execution. The last part is about execution, about accounts, sorry, is about platform and accounts and subscriptions. So how subscriptions work, and various topics related to reports, etc. maybe there. So these four topics, very high probability that the question you have might already be there, because many other people might have had the same question. We take a lot of care in making sure this is up to date, and if we receive some question from many people, we write a FAQ about it. So we will really encourage you to check this out. The other part, now, when you have a question, how to get that question answered. And we've put some thought based on, our learning in the last 1 year on the most optimum path to get your queries answered. The first most effective way is to check the FAQ. Very likely that the question you might have had, that you're having, others might have had, and therefore it has been answered. So, and also it's a very quick way of quickly getting the information. If there's more strategy rules related, how will it respond? How does it respond? How does it work? Is it fixed? Is it constant? What comes first? What comes next? I think a lot of those are in product videos. I would encourage you to see this. So if you click on this, it takes you to a YouTube collection. And here you'll have, one video for each product family. And very likely that, the question you have about strategy might already be answered there. And if it is not, please feel free to write to us at connect@smartwealth.ai. We are very focused on getting all the questions answered that come on email. Within one working day, I think most of our questions are turned around or answered. And if you have any short information that if you're seeking any short information, like where can I get this, where can I get that? If there is a very short information you're seeking, you can even, send a WhatsApp message. We don't support calls or SMS, but WhatsApp message on this number. You can, at the bottom right, you see, you can use that to send short message, get quick information. And of course, the most preferred continues to be, the email. If you have some sort of deep question, deep understanding that you're seeking, and you feel one-on-one conversation will help, you can schedule a meeting. If you click on this, scheduler like this opens, and you have all the slots listed here. You can choose the slot that is convenient to you. Give us some information and context about you so we know your question. Please be as descriptive as you can in sort of explaining your question, your context, so we can be, that much more helpful. And we make it a point to attend all these meetings and attend all of them promptly. So we'll really appreciate if you are also prompt in joining, and give us some context about your question well in advance so that we can make the best use of time. So that's about the resource on the website. Uh, Two other important parts. So if you see at the bottom, so we also send email updates to those who have subscribed. If you're not receiving email updates from us, we typically send one or two in a week. If you're not receiving, and if you would like to receive, you can subscribe to the newsletter on any of the page. There's a place where you can enter your email ID and subscribe. Also, a word of caution: if you see the bottom, left, there's an impersonation warning. It has come to our notice that there are some fake Telegram channels operating that are impersonating as us by using our SEBI registration number. This is to clarify, we do not operate any Telegram channel, WhatsApp channel. We offer no advisory on social media. All our services are offered via small case, and all our recommendations go via email. So please be cautious when you see any channel. And if you come across any channel, please do let us know. Whenever we, learn about any channel operating fakely as us, we raise a cyber crime complaint. So we will really appreciate if you can share if something comes to your notice. So with that, moving on to the next part. The email that I talked about. So once or twice in a week, we send out an emailer with market updates, special updates, and so on. It comes from this email ID, connect@smartwealth.ai. At the bottom of the emailer, there's a link to all the useful resources in one place. So you can think of this as a bookmark page. So the first thing is it has a link to our SmartWealth, the Sprint portfolio, Sprint diversified stocks portfolio. You can use that to benchmark if you would like. Also, there are links which can take you directly to our website, directly to the products page or testimonials page. If you would like to share your experience to help others, about your journey, something that you think might be useful to others, about your philosophy of investing, or how a model portfolio like ours fits in your journey, please feel free to nominate yourself and give us some details. We'll get in touch with you. There are also direct links that can take you to any product directly if you would like. On the right, the journey that you typically face from selecting a product to adding capital to rebalancing to adding diversification or extending your investment. So the FAQs specifically for those touch points have been organized here. So in one click, you can go and see. This can make it convenient for you to quickly get information. Also, the detailed FAQs along 4 categories. These links can take you directly to that category. If you have strategy related question, you can go there. If you have capital deployment related question, you can go to the second category. If you have execution, rebalancing type of questions, you can go to third category. If you have anything about how accounts work, how subscriptions work, how this report works, etc., those kind of questions are in the platform. So quick links. If you have any question that is not answered by our FAQs, not answered by product videos, please feel free to write to connect@smartwealth.ai. We prefer this as a mode of communication. But if you have any short question which can be quickly answered in a short way, you can also send a message on WhatsApp. And if there are any escalations or any deep conversations you want to have, both Sumit's and my calendar is public, is accessible. You can directly schedule a Google Meet link. I demonstrated that earlier. If there are any subscription related questions or platform related questions, you can schedule a meeting with Sumit. Also, deployment, execution related questions. If anything about core strategies, how strategies work, you can schedule with me if you are interested to hear or get your questions clarified. This will schedule a Google Meet. So this is not a callback. That means there's a meeting that will get scheduled on your calendar and either my or Sumit's calendar, and you have to attend that based on the time you have selected. So we hope these resources will make your journey with us very effective and efficient. And if you have any suggestions, please do share. We take these suggestions very seriously. One other resource is the manager updates section of small case app. So for every product, the third tab is updates, and we send weekly updates on this channel as well. And once a month, we review the major category level allocation, asset allocation level sort of decisions across all strategies. And this is useful to see which strategies are leading, which strategies are lagging, how is trend, how is volatility, is hedging activated, not activated, are we finding enough stocks to fill the portfolio or not. So those kind of things you can get a quick glimpse. This is a private update. That means this is visible only to those who are the subscribers and not visible to everybody else. And whereas every other update that goes on manager update is public update. So we'll encourage you to check this out. And as always, if you have any suggestion, please feel free to share. We are starting a new initiative, or we are in the last stage of kicking it off, which is educational track. So the content that we write once or twice a week, we want to add some education angle to that. So there are 12 months in a year and there are 12 themes here. So we want to share perspective on broader financial awareness. We also want to share perspective on broader quant investing. So these topics are listed here. I won't go through them. I would encourage you to check them out. And if you have any suggestions on how to make it more effective for you, if there are any topics that you would like to hear about from us, do suggest, and we will take as much as possible. We'll try to take those. So that brings me to the last section, Q&A. And I think we've sort of run out of time, but Sumit, if you have any, suggestions or questions to take.
Yes, Pankaj, we can take some FAQs and some questions that are already there in the chat.
Yeah.
So let me quickly start with some FAQs that we wanted to cover because they've been asked by a lot of our subscribers.
Yeah.
So first one is about gold allocation in the portfolio. So how is it determined and is it fixed? So this has already been answered by you, I think, as a part of your presentation. So this is not fixed. It's dynamic and it is done based on mean variance optimization. So you can review this video if you missed it. Then the second one is about how to deploy capital optimally, both in SIP and as in lump sum.
Yeah. So SIPs, the right way is to sort of synchronize with our review rhythm. Our review rhythm is as follows. All major decisions are made, major hedging diversification decisions are made in the end of the month. And stock related decisions are made weekly. So the first week of the month is when the portfolio is the most refreshed. So first Thursday of the month is ideal for you to schedule your SIPs. Lump sum, in general, it is not a great idea to take concentrated bet in a very short period of time. It is generally a good idea to spread, in a systematic manner, time-based manner across time. And weekly is too frequent and will have very high cost relative to monthly. So a monthly frequency is ideal for you to gradually deploy. But if you have large lump sum, it is generally a good idea to not take concentrated position and spread it across time. A simple rule is 1% rule. So no single day should contribute or have more than 1% influence on your wealth creation. Therefore, no single day you should deploy more than 1% capital. There's a very simple rule to think about lump sum and SIP.
Okay. The next one is why do we have maximum investment amount recommended for each portfolio?
Yeah.
So why is this recommendation and what happens if a portfolio crosses this amount?
Right. So let me just quickly answer this. We received this, we've received it a couple of times. So we've written a FAQ. Why do you set recommended limits? So the answer is very simple. The universe that we operate in, universe of stocks and even ETFs, it has finite liquidity. So it has a certain average daily trading. And we want to make sure we do not take a very large position in a small stock. So, you know, there is a certain liquidity that is delivered by the markets to us. We don't want to have demand that is larger than supply, because when we take a very large position, there is significant price slippage in execution. So when you're buying, you will programmatically get, achieve a higher price while buying. And when you're selling, you will get programmatically lower price than selling. And this price slippage is not desirable. Therefore, uh, you know, managing capital within the liquidity availability is important. So that's why there is guidance. And the portfolio design itself tries to manage the overall, trading size compared to the liquidity availability. So that's the reason. Although it is a recommendation, it is based on the design. It is not a hard constraint, although we very strongly recommend it.
Okay. And the next one is about scaling up the portfolio, especially for Aspire DSP subscribers. So what is the right way to scale up,
Yeah.
considering things like concentration risk if you want to avoid?
Yeah. So we've received this question from a few people. So we've written an FAQ about it. I'm an investor in Aspire Diversified Stocks portfolio, and I want to invest more than 10 lakhs. What are my options? So fundamentally, there are two paths. One path is that you like, if you like diversified stocks portfolio kind of an approach, and you want to go deeper into this path, the next logical thing is to consider Sprint diversified stocks portfolio. It has pretty much identical decision-making framework. Main difference is that Sprint is a 30 stocks portfolio. Therefore, it has larger capital deployment ability, larger liquidity. So if you want to continue on this path, go deeper on this path, then Sprint is the logical answer. But if you want to add diversification and sort of progressively reduce your portfolio volatility, then the logical thing to do is to consider add something from a different strategy family. So diversified assets or diversified factors, these have relatively lower correlation with diversified stocks portfolio. So by adding this, your combined portfolio will get a little bit more stabler, little bit less volatile. So those are the two paths: either enhance diversification or just go deeper into that path. And these are the answers for Aspire, but same question can come from any subscriber. So what we've done, we've put together a table in this FAQ where for any given product, you can see which is a suitable product to enhance diversification and which is a suitable product to go deeper into a kind of structure that designed to manage larger capital.
Okay. Great. So let me also quickly take some questions from the chat now, Pankaj.
Yeah,
And there are quite a few questions about gold allocation. So I'll maybe combine them into one. And like many investors have expressed their concern about the percentage of gold allocation that is there in the portfolio right now.
yeah,
And also because of the recent volatility in gold prices.
yeah.
So what are your thoughts on that? Can you please share?
So, so clearly, gold has had a great run, which is very nice. And this run will not last forever. So that is also understood. But there are divergent views on where it will go. and from all the analysis and understanding of how analysts are thinking, it can go either into further bullish scenario, or it can correct. So both of those are there. So how do we decide? Our approach is based on quantitative schedule based review. So the gold hedging related decision is made on a fortnightly cycle. So every fortnight we review, and the algorithm review is based on rules on what is the optimum level of gold exposure. This optimum level is determined using mean variance optimization. So it actually it compares unhedged portfolio with gold and says what combination will optimize. So this is how we will make our decisions in a fortnightly cycle. Now, depending on what the data is, the optimum level will be determined by the system. We cannot foretell it will increase, decrease, or stay. So the right thing for so our decision will be made like this, and the right thing for you to do is consider portfolio volatility to determine how much allocation you want to make, and definitely not advisable to take a large concentrated portfolio in a very short time.
Okay. Another question in the chat is about weekly rebalances. So since the rebalances are, or at least the reviews are weekly, rebalances will cause more transaction costs. So what are your thoughts on that?
So this is, yes, so there is no free lunch for sure. So if you would like to adapt more dynamically to the situation, then we need more frequency. And this is a decision that we made very early in our journey to have weekly as a, frequency for stocks based. For ETF based portfolio, it is less frequent. So ETF based portfolios are reviewed only fortnightly, and we also have a free portfolio Samvat that is reviewed once a quarter. So we have range of choices. It does have transaction cost, and in general, momentum based approaches have larger number of transactions. We made as much effort as we could to minimize the number of transactions, but inherent nature of momentum is to have large number of transactions. One very effective thing you can do at your end is to have low cost broker. So low cost brokerage structure is the most effective thing you could do to be, least cost at your end.
Okay. And we have another question. Is it a good time to increase the investments now that gold price is corrected?
So, well, the thing is, we never know for sure we are at the peak or we are at the bottom, or where we are. Is it going to rise? So, nobody knows whether it's going to rise further or it's going to fall, or it's really not a forecast driven thing. It is more responding to what is happening. And given that nobody will ever know for sure, the right thing is to have an approach that is not dependent on timing of events, but it's a more scheduled based thing. So the right thing to do is to have a programmatic investment, like monthly sort of a schedule based investment, and run that irrespective of the regime. If the market rises, then you have the you may have lower return, but you have the satisfaction that yes, I realize some return. If the market corrects, then you have the satisfaction that okay, whatever net new investments I've made, they are at a lower cost. So there's no way to foretell which direction it goes. So the right thing to do is to have an approach that will work across, and an approach that you can follow.
Mhm. Okay, another question is, since our strategies are quant based, so how do we factor in macro conditions and geopolitical conditions in the
Yeah.
while constructing the portfolio?
So it's a great question. The way it gets factored in indirectly is through universe design, right? So if you see the universe consists of a very wide variety of things, right? It has a very wide. So we are not concentrated in any particular sector, any market cap, anything. So when you have a broad universe design, and it also is across assets. So when market something is changing in the market, it it affects the interplay, the dynamics among assets, so right, between gold, equity, and debt. So it indirectly gets captured in the momentum of these assets, right? So when equity is not doing well and gold is doing well, it is already telling you indirectly what's going on in the market. So while it is quant, the universe design and the strategy design indirectly, captures and adapts to what's going on in the macro environment and geopolitical environment. So it is
Okay.
not qualitative. Your observation is right. It is not through human intervention, but the universe design and strategy construct is such that it should blend in the changes in momentum across these things.
Sure. And the next question is, what is the impact on the existing subscribers about the price revision you announced?
Yeah. So great question. Those who are existing subscribers, they will not see an increase in price. So those who are existing subscribers, they can continue to enjoy the existing prices so long as there's no break in renewal. If there is a break in renewal, then of course the restarting will be at the new price. So for existing investors, existing subscribers, there's no impact.
Great. I think all the questions in the live chat are also covered then.
Yeah.
So that brings us to the end of this webinar. Thank you very much, everyone, for joining. We appreciate you taking time on Sunday to join us. Pankaj, you have any closing remarks?
Well, thank you for joining. This was the first webinar of 2026, and also it is coinciding with the budget day presentation. So our goal was to finish sooner than 11, but we've crossed it. But I hope you found this webinar useful. It answered most of the questions that you have had in mind. If there is anything unanswered, please feel free to write to us on connect@smartwealth.ai, and we will respond. And if you have any suggestions on how to make this webinar better, please feel free to share that as well. With that, thank you very much for joining, and have a good Sunday ahead.
Thank you very much. See you next time. Bye bye.